Hello everybody, welcome to another episode of Erickson TV, courtesy of Lauren. Hello Lauren.
Hey Curtis.
Hey Lauren, last week we talked about the Robo-Advisor,
right,
and
yes.
about how many of these dying firms are adopting that model,
right.
along with some of the more independent firms like Betterment that have huge venture capital behind them. And basically the goal is to increase assets under management,
right,
with the least amount of expense, and so the fees they charge could be the most profitable. Makes
yes.
sense? So one advisor named Adam Nash isn't fond of the Robo-Advisor label because he said that he has a problem calling themselves advisors.
Right.
Okay? And so, in fact, advisors, you would agree with this, advisors are more than just helping create a portfolio.
Right,
and
precisely.
there's huge issues with risk management, with insurability. When's the right time to take Social Security benefits?
Mm-hmm.
When should you quit your job?
What should you do about taxes?
What about taxes? That's a big one. And a lot of it. So, and also I think about, and this has been a problem with these so-called advisory firms that really aren't truly advisors, and I won't mention any names in this episode. We talked about them last episode. But the fact is providing the discipline when markets are
right,
going sour. And so, can you talk a little bit about that? Because one of the things that I have a concern about is that we continually talk about the Dalbar study and
right,
the fact that individual investors that are being tracked compared to market averages are severely
right,
underperforming over long periods of time. 2 to 3%, and sometimes as high as 5 or 6%, depending on what time period you're looking at. So, what's your take on that?
Yeah, so the robo-advisors, right, they're not advisors at all. They're just the sort of next technological step up. You actually mentioned this in the last episode a little bit. They're the next technological step from just offering people a call center.
Right.
That's it.
Right.
And they
it looks like their apparent at first they kind of look like a traditional advisor. They help with asset allocation. They might even create like index funds, or they might.
Yeah, because a lot of us got a little too comfortable just giving people a questionnaire and saying, "Hey, fill this out, and then we'll figure out what to do." You know, you don't need a human being to give somebody a questionnaire and say, "Hey, fill this out, and let's plug it into our program and see what the program spits out." You don't need a human being to just run a very basic financial planning program. If the client enters in the correct numbers, then poof, out comes the answer. What you don't have is an actual human being who knows anything from experience about how this stuff actually works, or doesn't know how to ask the person questions about, really, is this how much money you're going to spend? Really, is this your risk tolerance? Really, what are we going to do when things don't work out? When the market goes down, not if.
Right.
When the market goes down, what's going to happen? And so what I think you have when you call it a robo-advisor is you're trying to call it something to make somebody feel like they're getting something, but that's not really what they're getting. And I'm not even sure if legally they're going to be able to keep calling themselves advisors. We'll see.
Yeah, that's a good point. And kind of the end of this episode, whether it's a call center at Merrill Lynch or a robo-advisor at Schwab or Betterment or these other ones, when times are really difficult, such as Black Monday in October of 1987
right,
and 2008, early 2009, right, they're not going to provide advice that what you should do. They're going to do whatever you want to do, and your emotions, or what are the people's mostly emotions tell them what they want to do in those difficult markets. They want to sell.
Yep.
And robo-advisors and these call centers will not give you concrete advice on what to do. And so that's the real problem that I have with them. Really, I think advisors earn their fees during the more difficult times than they do in the good times. And
that's right.
These guys are latching on to the good times. So, all right, thank you very much for watching this episode of Erickson TV. We'll see you next time. Bye now.
See you next time.